Thomas, I've got Jeff Olin with me, Vision Capital. And, I'll just tell you a little story about Vision Capital. They've been doing this, oh God, for 20 years. They've always outperformed the Toronto Stock Exchange. They risk manage beautifully. In fact, I'll give you an example. First quarter this year, we got the real estate challenges, but not for them. 5% plus in the first quarter, outperforming, of course, all the REIT indexes, but it also had a fraction of the volatility. And I think that's a key point right now. I won't go more into that, but just to say that the Vision Alternative Income Fund is out there for you and qualifies for RSPs, et cetera. Jeff Olin joins me right now. Jeff, first of all, appreciate you finding time with us. And I was talking about commercial real estate, not long ago with Michael Levy. And so give me your quick take on commercial real estate.
Well, commercial real estate encapsulates potentially a broad number of property types. So it could be office, it could be industrial, it could be retail. Some people consider apartments as part of commercial real estate, for example, self-storage. So, you've got to bifurcate by property type and by geographic region to get a thoughtful answer to your question. So you had in the first 6 months of 2022, for example, everything got crushed. Correlations went to one. It didn't matter if you own U.S. corporate bonds or government bonds or S&P 500 or tech stocks or the REIT index. Everything went down 18, 20%. And of course, that's not sustainable because everything is not the same. And that comes back to your question. And the difference is, if you look at the last 20 years, the difference in the REIT sector between the best performing REIT quartile and the worst performing REIT quartile showed a differential in performance of 49%. The first 6 months of 2022, that was 15%. So we like these markets today when the answer to your question is that there's volatility and certain sectors outperform. So, office space, obviously not so good. Commercial real estate, industrial real estate, it's outstanding. Retail, grocery stores, pretty good. Fashion, not so much. And so all are being challenged to varying degrees by debt levels, some more than others in that as well.
By the way, terrific answer. Thanks. But also, you just illustrated how important selection is. If you can get a 49% disparity between the best performing and the worst performing, that also tells me that, your ability to select and Vision Capital's done a brilliant job of that. And I should also tell people that Vision Capital plays stocks to go up and go down. They focus on the stock market where valuations can get unrealistic or they can get so undervalued. It's just the difference. But obviously, selection is real key. Maybe it's just recency bias. I feel that selection, though, and your ability to select the right properties seems more important than ever.
Oh, that's the punchline here. I mean, when a rising tide is lifting all boats, it's harder for guys like us to differentiate ourselves. We're a long short fund, as you highlighted, and we don't use any long side leverage. We don't buy stocks on margin. So we never have full exposure to the market. But now, when there's such volatility, stock picking matters more. So, for example, in the first quarter, it's one of the very few quarters we've had in 15 years where our long positions were up, our short positions were up, and our paired trades were up. That is very unique for Vision in terms of our strategy, and it reflects that volatility and why it's a stock picker's market.
I mean, obviously, just even an interview like this demands some oversimplification because you spend all day, every day doing this stuff, and I'm sort of saying, can you sum it up? But you had mentioned a bit ago about debt levels. That seems to be a theme throughout. I'm worried about the banking sector, the regional banking sector, if they've done lending to an office building that's now partially full and partially empty, that kind of thing. So is that the key, you think, when you first start, the overlay, you go say, I'm just going to check their debt levels and see if I'm going to even take a minute to go further?
Well, balance sheets are always critical. In times like this, they're very critical. You must assess a balance sheet. But generally, it's a check in firstly. Sure, if you got a lot of high cost variable rate debt with that maturing, that's going to be an issue depending, if you're an office building, you're probably not going to get that refinanced. I mean, you've seen Brookfield giving back the keys to lenders. You see Blackstone giving back the keys to lenders in office buildings. But generally speaking, in the REIT sector, this is not an issue. Private market operates 60-70% leverage. What you've seen, I mean, as we were saying, some people call us old, others experienced. In the 1990s, when I worked in real estate, Bramley Limited, some people may remember that, but it was no different. Bramley, Cadillac, Fairview, Trizac, Olympia, New York, Public, everybody operated maybe 1.1 times interest coverage ratios. The transformation of ownership from entrepreneurial, even the public companies were run by entrepreneurs, to pension fund and REIT hands has created a much more conservative landscape in the balance sheet. So today, in the US REIT sector, you have over 5-to-1 interest coverage ratios. You have 90% fixed rate debt with a weighted average term of 7 years. You have loan to values low 30s. So yeah, the private market, if you're 60-70% leverage and you wanted variable rate debt, you've got some problems. But there's not going to be any distress on average in the REIT sector because of the very conservative balance sheets.
What? How is liquidity playing into this? I mean, you mentioned, is it BlackRock that said they suspended distributions or whatever they were? You couldn't, redemption is the word I was looking for. But you guys trade on the open market. You guys trade stocks. So I would think that's an advantage, a huge advantage right now.
It's more than an advantage. I mean, forget real estate. Real estate's amongst it, but we've been telling folks for years, anytime you have a mismatch between the underlying liquidity of what you are investing in and the liquidity which you promise investors, are accidents waiting to happen. And we said potentially Blackstone REIT, B-REIT, might be the biggest accident ever to happen in financial market history. Now, they're smart. Their documents are drafted appropriately. If you read them, they tell you you don't have full liquidity. You can not get your money out at certain periods of time. But the marketing information, which you focus on, will tell you have liquidity on 30 days notice. It's not just Blackstone. It's Starwood REIT. Mm-hmm. It's KKR. It's Schroeder's Real Estate Fund. In Canada, debt funds, Rothschild Mortgage Fund. And this is a problem. And REITs, so for fourth quarter last year, on average, these private REITs, which aren't listed, they self-evaluate their net asset value. They self-report. They use appraisals if they can get them, but they're lagging indicators appraisal. Where markets going up or down, they're lagging indicators. So they reported an average 13% increase in their net asset value when the REIT index was down 28%. Does that make any sense? A premium for liquidity? I don't think so. And so that was over 41% differential. That's like a huge, even in March 2020, we didn't see that differential. And so that's not sustainable. And the key question is, which one is right? And we say both. In certain sectors, the stock market has it right. Office, I've been on your show for many years. You know my view on office. We've generally been short forever. I've never seen anybody with a buy and hold strategy make money in office. That was before the pandemic. So the stock market, we think we were the most pessimistic guys in the planet in office. And the stock market has taken it down 60, 70, 80%. And it's probably done a good job there. But other sectors, industrial real estate, I mean, we had in Canada in November, closed in February, first quarter, in the worst credit environment since 2008, the government of Singapore pension plan shows up in Canada, bids and buys Summit Industrial REIT at a 34% premium to where it was trading in the stock market and a 20% premium to the REIT's own reported IFRS accounting value. And by the way, within 3% of what I shared with your listeners on your show in terms of our view of value. And, that is because the fundamentals are solid and a cap rate assessment is irrelevant in that sector. Who cares about a cap rate when you have a gap of 60% between in-place rents and market rents? The next year 12-month return is irrelevant. You must use a discounted cash flow or an internal rate of return to how to capture that 60% gap in rent growth. And that's why it traded at a premium. So these are some of the factors that are relevant to your comment.
Well, and and plus the context of this is in the States, at least some banking challenges, not so much in Canada. But I'm just wondering if there's opportunities that come out of this for someone like yourself. Now, first of all, I want to reiterate, Vision Cap plays stocks to go down too, real estate stocks to go down, and has done extremely well. And you've shared some of that with our audience, and they've done extremely well, as owners. But I'm just wondering about the environment now. Are you sort of licking your chops, saying there's some opportunities coming because people are going to have forced liquidation, or they will have to have an exit event, and they probably aren't doing it on dollar for dollar?
I mean, we like, as I said previously, we'd like the volatility, but our big picture view is caution.
Mm-hmm.
We believe, and our base case is assuming a recession. So the key question, or a key question, how do REITs do in a recession? Because that's, to be as conservative, our risk metrics are preservation of capital. If you don't lose money over the longer term, you'll probably do pretty well. So if you look at the last 6 recessions since 1978, during recessions, REITs have averaged a return of 15.9% on an annualized basis. The Russell 1000, 15.3%, private properties, 60 basis points. In the 12 months after recession, last 6 recessions, REITs have delivered 22.7% returns, the Russell 1000, 8.2%, and private properties, 5.2%. So REITs look like a reasonable place to be in a recession. And so we're always pretty focused at Vision, but in light of our cautious outlook, we're more focused than we've ever been on really only 3 or 4 investment teams. I mean, one of the things, we don't have to buy, index. We don't buy indices. We're not overweight or underweight. If it's a sector we don't like, we're not going to be invested there, and we might be short. And so this is a good time for us in that sense that this volatility, stock picking matters.
And the expertise. Yes. Give me, me, Jeff, I always put you on the spot. Can you give me a couple of examples just to walk us through this, things that maybe are on your radar screen or we could put on our radar screen besides, obviously, the other answer to that is when you look at the Vision Alternative Income Fund. I mean, the performance has been very, very strong. But, what are you guys looking at right now?
Well, there's really, as I said, 3 or 4 sectors. So maybe I'll start there, and then I'll perhaps give you some names within the sectors. But we continue to like, as I mentioned a few minutes ago, the industrial real estate sector, and one of the reasons is that there's 3 powerful secular demand drivers that weren't there last time there was a recession. So the first, everybody understands now, is e-commerce. Spiked to 25% of total retail sales in March 2020. Now it's come off below 20%, but analysts indicate by 2030 it's going to be 30%. Now you might say, well, Jeff, you said recession. Okay, so Walmart sales will come off. But Walmart will still need that distribution space to deliver the sales they have, an increasing amount because of e-commerce. That's number 1. Number 2, reshoring. The return of manufacturing to North America. Canada couldn't rely on the United States when Donald Trump blocked their masks at 3M Corp, from 3M Corp at the border in April 2020. Do any of us want to rely on China for pharmaceuticals? I don't think so. This is happening in a huge way. Hundreds of billions of dollars investments have already happened. 2 chip manufacturing plants outside Austin. Taiwan Semiconductor doing a facility outside Phoenix. Intel investing over $100 billion outside Columbus, Ohio. You see that the electric battery plant in Ontario, the announcement. These are 50-year decisions. They're not made lightly. At the Three Amigos conference in Mexico in January, your Prime Minister, Mr. Trudeau, along with President Biden and the Mexican president, had one major policy statement. 25% of all imports from Asia to be manufactured onshore North America. Powerful. The third is We've touched on this in your show in the past. The death of just-in-time supply chain being replaced by just-in-case inventory management. And the metaphor is Nike will still make shoes in Vietnam or Cambodia or China, but Nike will carry additional inventories in Western economies because of supply chain difficulties, because of wars, and these are powerful. We watch supply. It's easy to build this stuff, but we only see in a few markets, South Dallas, Indianapolis, Phoenix, Little Central PA, with pickup of supply. So we see significant rental growth and very favorable supply and demand fundamentals. And that's what led Summit REIT to be sold to government of Singapore. So that's one sector. Within that sector, we like Dream Industrial REIT here in Canada. We love First Industrial REIT in the United States. FR is its symbol. The symbol for Dream Industrial is DIR. .UN. Both have nice yields, both trading at big discounts to net asset value. One of the reasons we like these markets is sectors where the fundamentals are great, but the stock price had reflected them on typically, so they traded a premium to the underlying value of the real estate. We love the fundamentals, but their stocks are too expensive. That's not what we do. We like to buy at a discount to value, not at a premium. Well, this poster child for what I'm talking about is manufactured housing communities. The single best property class for the last 50 years. Institutions didn't get it for 30 years. Simply put, you go and you spend $200,000 to buy a prefabricated manufactured home, and you put it on their land. They charge you land rent. You, the homeowner, pay the realty taxes. You, the homeowner, pay the operating expenses. It's the most pure form of cash flow in the real estate space. Never had 12 months of declining net operating income. So stocks typically trade at a 20% premium to the value. Well, in August 2022, November 2022, March 2023, we're buying into the very best names, Sun Communities, SUI, at $17 billion market cap at a discount, significant discount to net asset value. They reported their earnings last night, very strong earnings. So that's another sector that we like. We love grocery store, pharmacy, and shopping centers, in particular in Canada, First Capital REIT, FCR. The single best portfolio globally. 6 major urban centers only. Toronto, Montreal, Calgary, Vancouver, Edmonton, Ottawa. No secondary markets, no fashion centers. Stock's worth $23.80. That's their IFRS value. Trading around 16. You get a 5.5% dividend. Activism recently occurred there. We were in the middle of it. We have 2 of our directors are now on their board, and we think this is a very competent board that is now aligned to service that gap between $16 and $23.50, and you can collect your 5.5% dividend along the way while you wait. So those are some of the names that we love.
But that's a great example, though, is what you look for, in the market is undervaluing, a company and a company's asset. And I say when you find those situations, it's difficult to imagine a world where they could rebuild any of that stuff or start creating any of that stuff for anything but higher prices. I mean, I think that's got to factor into it, too. I mean, I'm not going to put words in your mouth, but we're pretty clear that on Money Talks, and I think we've been accurate on this, is the sort of the slow rise in commodity prices, the pressure to rise, whether it's because of the huge demand coming out of renewable or EVs or what have you, but construction materials, it could be energy, whether it's diesel, could be fuel. They're not going to rebuild any of that stuff for lower, going forward. So I think, when you find an undervalued situation, I think that's got to even further propel the opportunity.
Yeah, I mean, it's very relevant to real estate. Hard asset replacement cost values go up in an inflationary environment. So it doesn't matter that much in a market like Calgary office where the vacancy is 30%. Replacement cost value still goes up, but it's not going to impact the transaction value. But in the sectors where industrial, where the vacancy rate's 1%, it matters a lot. We like Boardwalk REIT in 61% Alberta. We're cautious on apartments because of populist rent control regimes, but Alberta, one amongst the last places in the planet, we think you'll see rent controls, even if the NDP do win the election there. It's not part of their platform right now. And to build new, apartments is expensive. And so affordable apartments trading at a discount to underlying value is a pretty safe place to be if you're cautious about the economic environments. You got to live somewhere.
All of these trends, and you've done a wonderful job delineating them, but, these are powerful trends that aren't sort of a 2-week trend or a 1 month or a 1 year. So when someone buys something like the Vision Alternative Income Fund, and I know individual circumstances change, et cetera, but what kind of time frame do you think is realistic for people? Is it 3 years, 5 years, as a starting point? Because it's ridiculous to think it's 2 months.
Yeah, I mean, you have liquidity on your investment if you so choose monthly. But if you don't have a 12 to 18-month time frame, we encourage you to not invest with us because the themes we focus on, precisely to your point, take a longer term time to play. I mean, we say our blood is supply and demand. Some of the cliches in real estate we say are nonsense. Location, location, location. Again, picking on Calgary office, you can have the best located Calgary office building. How's that going for you?
Yeah.
Not so good. Interest rates, fallacy. It's always supply and demand trumping interest rates. I don't care whether rates are going up or down. And so by definition, if you're looking at supply and demand, these are trends that take time to play out. To build a new building could take 2 to 3 years. You know it's coming, but it's not there yet. It's not accepting tenants. Demand trends, it's employment growth. You've got to look at employment growth trends, and it takes time to play out. So yes, you should have a longer term horizon, but if circumstances change, the nice thing about our strategy is you can seek and get liquidity without gates.
Well, as I say, I think this is a fascinating time, but what you've reminded me, and it's important, is that expertise is key. I mean, just the distinctions there. It's not a broad brush here. It's selecting the right stuff, looking for the right opportunities, and your track record speaks for itself. As simple as that. I always say this is a track record business, and it speaks for itself. And so, again, if you're interested in this, go to visioncap.ca, visioncap.ca, the Vision Alternative Income Fund. All of that, all of the details, all the information is there. Jeff Olin, we appreciate you finding time for us as always. Great stuff.
Nice to see you. You look well, Michael. It's nice to see you.